Good morning, Warriors. Minute early, BOE incoming. Take it away, Blake.
Hey, good morning, everybody. Thanks, Dale. We are expecting the Bank of England. So I got the data flash up here. I know Ryan and Kman are here as well. Real quick, let me get rid of that and let me pull up that data flash. Yeah, just a heads up. Now, we're not expecting any move on interest rates, unlike the Swiss National Bank. So here we go. Now, rates unchanged.
8-1 votes.
Yeah, there we go. That's a surprise, right?
Yeah, the hikers have given up, but no addition to the cutters.
Wow, there goes the cable getting smashed right now. There, you just a 1 minute chart. I mean, we just dropped like 20 pips, so a little bit of move lower, but it seemed like the market was really leaning into this going into today. Something you guys were talking about just on the flow show just moments ago. So how do you think the market's reaction to what we just heard is, Kay?
Wow. Yeah, I think a bit logical. It was already the market was already leaning a bit towards a bit of a weaker sterling, but we'll see how long it lasts. I haven't read the statement yet, but yeah, sterling is a tad lower. I haven't read the statement, so I don't know, but I don't think that it's like, well, I wouldn't.
It won't justify an actual break higher in, break lower in sterling and a break higher in the euro sterling. So, I mean, I'm not going to do it just because I've got too much other stuff on my board right now, but shorting euro sterling right here makes sense to me.
Yeah, I think it doesn't change much to the global picture. No, I mean those ranges are still there, right? Until it breaks.
Right. Until it breaks. Yeah. So I mean, if you're gonna trade right now, you should have been looking at the short right here. We've been talking about this every morning here on the F.A.C.E show. You get up towards the 85-80 level, you sell it right into the range highs, and then you put your stops within 10 pips from there. So the risk reward is very manageable at this point. Ryan, I can hear you typing, but what more importantly is I see that in the ForexAnalytix chat room, you just posted all the headlines. As you can see here, guys, this is inside the ForexAnalytix chat room. So Ryan, what are you seeing and what are you hearing?
Yeah, so just posting it all. It all looks largely rinse and repeat of their position stays the same as it was the last meeting, though they have said that the May monetary policy report, which is like the forecast meeting, is potentially going to be something they're going to look at. So I'm still reading through the details.
Yeah, no problem.
They're going to take the budget in. They're going to take the budget impact into account in the May forecasts. Further encouraging signs of inflation, not yet at the point to cut rates. Yeah, so the Hawks move into neutral. That's probably the bigger news of the day. Both moving makes things less non-dovish, so a bit more to the dovish side of things, because one would suspect that the next move would be for some of those holders to start moving to the cut column.
But so, as you guys were talking about on the flow show this morning, which happened to be just about an hour ago, you guys were, well, 2 hours ago, but I was actually listening to you guys an hour ago, is that the market had been leaning into it. So I'd be very hesitant about chasing that lower, sterling lower at this point. I mean, unless you see some massive dollar move come through the market. I couldn't imagine trying to short sterling right now after literally a 50 pip drop this morning. What are your thoughts?
Yeah, well, I've just taken some profit off my euro sterling longs.
Good for you
in this move. But yeah, I was saying on the flow show, I don't expect euro sterling to bust a move out of that 85. At the very most, we might get a run up to 85, 70, maybe even something closer to 86. But I didn't see anything coming that would significantly change the needle on this one. August is still the date in question. They're not there yet. It's almost like the Fed. We're not there yet. We're thinking about cuts, and wait until the next few meetings before deciding what they're going to do. So yeah, no reason for the pound to go anywhere really right now.
All right. Well, Dale, the Bank of England is not the only game in town. Obviously, we just came off the Fed meeting. We had the Swiss National Bank that actually gave us a surprise cut. Thank goodness. I think there's a few of us that went into overnight with some short Swiss exposure. I did. So I woke up this morning pretty happy, and I know a lot of you all did as well. That was a bit of a surprise cut, and you can see the Euro Swiss is broken out and actually completed its butterfly pattern today. So I mean, we were within. This is Dale. This is the old adage of the horseshoes and hand grenades, right? You're within a few pips of completing a pattern. It's probably complete, but that probably means that we're going to go a lot lower in the Swiss franc unless there's some geopolitical risks that arise that attract Swiss buyers. I don't really see it. But Dale, I want you to take over in a minute, just because I know there's probably some charts that you want to look at.
No, that's okay. I mean, basically, my plan over the weekend was to sell cable at 28, wrong over 29, playing that false breakout. I did it this morning.
Good. Yeah. I mean, that was it, right? The false breakout, you can see it circled right there. And I'm assuming, and this is kind of what we're just thinking, is we're in this ascending channel. So any move back down to the 126 level is going to be supported, and any move up towards 129 is going to be sold. So
24-ish.
What's that?
Looking at the same objective as yesterday.
Okay.
I think yesterday, I know yields are moving today, but yesterday the markets acted like the 10-year was down 20 bips, the way gold flew and the dollar sold off and the market rallied. And really yesterday, yields didn't really budge. They are today. But anyway, I thought that was, I think Ryan actually, his narrative was spot on. That people were wrong-footed and being too bearish, and you could have been long anything and made money. I think he's the most intuitive trader on the team.
That is it. I mean, he said it yesterday that the market was leaning a little bit too far in the hawkish camp, or in the dovish camp, excuse me. Or no, hawkish camp. Sorry.
Yeah.
It's still early in the morning here. Yeah. Ryan, why don't you go ahead and tell us what your position was yesterday, because you were correct.
Yeah, well, thank you very much for those kind words, Dale. It's it's always a team effort that we do here. I didn't actually initiate much in actual trades yesterday. I was already sort of positioned for reaction that way, being long euro dollar, long stocks. So it's more a case of just taking some profit on the table. The market was hawkish, but the weird thing is it was hawkish about the wrong things. It was hawkish about these two rate cuts thing from 3 rate cuts. But the details of the FOMC, the GDP forecast moving up, inflation forecast moving up, the dots moving up, unemployment expectations turning more bullish. The reasons to be hawkish were there, but the market was just wanting that 2-cut thing, and it didn't get it. And stocks not getting it either was a green light to keep on going. So 3 cuts remain. The path remains the same. The market got overly hawkish. It's had its arse handed to it. And you look at a chart now, and we're pretty much back where we were before the PPI and retail sales data last Thursday got the market moving on these hawkish expectations. So, we're back where we started. We've had a fun few days. Thanks for playing, folks. And now we can all go home.
I talked about this last night, and Dale, you're going to appreciate this, because this is I talked about I did it on the trade-off show, the Australian show that I do with Chris Weston. If you guys didn't see the recording, I'll just give you a little heads up of what I discussed. I discussed the anatomy of a blow-off top. And this is basically the chart. And I want to show you what it really looks like. So when you got an ascending channel, in this case, stocks are cruising higher, all of, 2023, basically. And then you get a move above channel resistance. Dale, you would classify a move above channel resistance or a move below channel below channel support as a what, potentially? I know it's early in the morning.
Well,
So
if it's a downtrend, and it's not just the channel, it's only the return line, not the channel line.
right,
So
but you would call this, if we start breaking above a channel, the risks are that we might get a
the
throw,
return
right?
line of the channel is the upper line. So
Right,
you
right.
would call it a throw over.
Throw over, correct. And what happens when it doesn't, come back into the channel? Well, it starts a new trend, right? So you in this case, you can see the light blue channel. We made it above channel resistance. We wouldn't pull back. We couldn't pull back. Then we started developing another rising channel with higher highs, higher lows. Then yesterday, we broke out of the next channel, and yes, we are still at risk of a throwover. Today, if stocks come down, then we'll get that throwover, quote unquote throwover that Dale talks about. If not, we are creating a new channel with even a higher degree of loft, if you will, which is in essence what we're building a parabolic move. You can see as the parabolic move developing.
I reshorted Apple yesterday. We haven't even been able to get back to the breakdown.
Yeah,
So,
anyway. I mean,
anyway.
I understand that, but and I'm just showing you that the broad markets are not making lower lows. They're making higher highs and higher lows. And the rate of change is accelerating higher, which this is the anatomy of a blow off top as we're developing it. And then all of a sudden, whether it's today or tomorrow, if things continue this way, or maybe next week, you're going to get the market cascading higher. Just like if you saw a crash going in the opposite direction when the markets crumble and they capitulate. This would be the exact opposite when you get a blow off top. So what happens is the market is not making lower lows. And there was something big that happened overnight. I don't know if you guys saw this. Micron Tech, they had earnings. And remember, they're part of the semiconductor index. It is up, what is it? Up 16% this morning.
Wow.
Micron, hailed as one of the better AI plays in the years ahead. This is a situation where stocks are just climbing, and you got to look around and go, okay, you have central banks easing now. You got the not only just the Fed put, you got the Swiss National Bank put. You have, coming up, the Bank of England put. You're going to have the European Central Bank put. You're going to have, and so tell me the reasons why, with data where it's at, that we should be falling. And I'm not saying that we can't fall. I'm just saying that this is what causes a situation where anybody who's bearish, like the Nouriel Rubinis of the world that capitulated last week, that just say, you know what? Forget it. I can't fight them. I might as well join them. And that's, where we start getting, the markets accelerating higher. So, it's scary because if you look at the daily charts of the S&P, we continue to every day on the morning edge, which is the show after this for the ForexAnalytix subscribers. You can see I just keep putting down support levels. I'm like, unless we break that support, you can't be short. Unless you break that support, you can't be short. Unless you break this support, this is from yesterday, you can't be short. And every day we're going to continue to draw like support levels that don't get taken out. And until they get taken out, there's no reason to be on the short side. So, of the broad markets. Now you can find your individual stocks that are going to not necessarily play the game, but I'm just explaining to you guys what we're seeing is really, really, we're in the stages of developing this blow off top, unless we see some lower lows. I don't see it happening. And again, we're in a situation now where central banks are now starting to cut rates. So, and the Fed's not too far away. So anyway, and growth is good, and earnings are not bad, and the jobs reports, or excuse me, employment is not bad, and even the Fed yesterday. And I'm going to let Ryan and Kman talk about this real quick. They're like little just kind of comments on the Fed, because I want to hear their opinions here now that this is all passed. But even the chair said, yeah, I see the inflation, and I see last month's prints, but the trend is moving lower. Look past that. I'm going to look past it. So you should look past it too. And I'm not saying that inflation won't be sticky, because I still do think it will. But right now the Fed's like, yeah, don't worry about that. So Ryan, or since we already heard from Ryan, Kman, what are your thoughts about the Fed yesterday? Let's hear what you
exactly as what
and good morning.
what's been said, and I've shown it over the flow show as well. The market had to redefine their expectations once more. There were two things to me that forced this market to rethink its stance, or at least make the pendulum swing. There's one that the dots did not show the most hawkish expectations, and the market was clearly positioned for that. And then the other one, when he talked about QT, and again he was extremely vague, but he said something about soon. So there as well, I think that's where the 10s rejected the 430s again, I reckon. And that's just a combination of everything, had the market needing to rethink again, and the pendulum swung, and now we are here, as Ryan says, back from where we started. And we're waiting for the next set of data, I guess.
All right, and
that's mostly what I have to say about the Fed. I was much more interested in what happened at the S&P this morning.
Yeah, and by the way, great call on the Swiss National Bank. I know you and I have been running Swiss shorts pretty aggressively. I feel a little foolish that I got out my Euro Swiss, but you go into an event like that, which is heavily skewed for a hold. And I know I don't know what you were running overnight. I kept my Swiss yen shorts, but my Euro Swiss, I pulled off after running them for the last 5-6 weeks. But great call, man. Really good stuff.
As I was saying, this is somewhere a team effort as well, because there's several of us who have been preparing this trade since the end of last year, and I've been in this trade since December.
Yep.
And while today I decided at least to take my option off in the dollar Swiss for a fairly decent chunk, but I'm still running long Euro Swiss and long sterling Swiss, because I'm just not overly sure about the dollar. Well, I'm actually tiny long dollar Swiss, but nothing that's a real position. But I still think that after Jordan's comments this morning, that okay, the S&P still will play F.A.C.E as they find it necessary, but he said this is not at the order of the day. So he acknowledged that we are not yet at levels in the Swiss franc where he thinks that the market is starting to undo all their, what he says, good work on inflation. He was talking quite weak on inflation as well. I also think that he gave the Swiss corporates what they wanted, what they were asking for. And he's not really standing in the way of a weaker Swiss. So I do think that in several currencies versus Swiss, we are not at the end of the road. As I was also saying in the chat room, it's a bit a shame that those European PMIs came in weaker, because I personally still think that we may be on our way to parity in Euro Swiss over the longer run. But we had the rate cut, so I thought it was good to at least take partial profits on what we have been working towards over the past 3 months.
Yeah, and technically speaking, just as I was mentioning in the ForexAnalytix chat room, guys, this is where By the way, this is where, you know, the sausage is made and the magic where it all happens right here. You know, is just, you know, talking about like these charts and, you know, the Euro Swiss, unless we start to see anything, you know, really attract Swiss buyers, you know, whether it's a, you know, a bout of risk off or whatever the case may be, this formation will turn into to that. So we can see a move to 99.50 pretty easily. And now the Swiss National Bank is moved. They've sidestepped out of the way for us. So now we just need a little bit of euro stability, and we'll see if that can happen. Ryan, let's hear what your take is on the FOMC overall. I mean, I know we just heard you about the Bank of England, but what were your thoughts and what were your big takeaways, especially with, you know, stocks moving higher? What do you think?
Yeah, well, as I said, the line was pretty much a repeat of the last couple of meetings. There was no real change to guidance. But this is one of those situations where the market leaned too far one way in their expectations, and they got a spanking about it. And you know, they'll do it again. You know, the next bit of data, we've got PCE next week. That's going to be big because, you know, if you get something like the core down at 2.5% or less, then that's going to really get the market getting all cutty again, because they'll think, right, well, we're near the inflation level. And but Powell's doing a bit of a trichet. He's using this confidence line thing, and it's the degree of confidence that he's using to give the market hints. At the moment, you know, they need more confidence. But if he ever comes out with a line like we have far greater confidence now than we did, then you're setting up for a cut in the meeting or two ahead. So it's all about the language, and you know, we've got a lot of data to come. I just hope that volatility doesn't drop off. Now we've got over these big meetings while the market waits to see what comes next. That's my fear.
Yeah. Hey, Dale. Let me ask you this, and I'm gonna put our tinfoil hats on. I know you have yours sitting next to your desk. Do you mind putting it on your head real quick? I'm gonna put mine on real fast.
I never take it off.
I can see just Dale sitting around with his tinfoil
like
hat on his head
man.
in the mornings trying to drink some coffee. So, well, no wonder you got a headache, Dale. I mean, you know, come on, you know, just kidding.
It attracts lightning.
Yeah,
I thought that was hair. I thought that was your hair. You said it's tinfoil.
My hat.
So here we are. You know, we've got how many meetings left? 6 meetings left, right? Markets pricing in three rate cuts. You know, no one, the market's got very little, less than 10% chance of us cutting next month. So that ain't going to happen. Or in May, I'm sorry, May. Then you got June. That there's still very little chance that there's a cut in June. And then we got 4 meetings left for the year. Markets pricing in 3 cuts. You know, do they front load or this is where the tinfoil hat comes in. And again, I don't want to make this a political show, but we are going into an election year and cycle. How about the Fed, you know, says we're not political. Everything that we do is as you know, not political. However, how about if the Fed, which never historically does, starts cutting into an election? Now, every macroeconomist you listen to will say they've never done it. They never will. Yet the market's pricing it in. Is it possible? I mean, because, you know, this is going to be a very, very trying election between, you know, Democrats and Republicans. And I don't want to make this a political show, but could the Fed show its true colors and maybe support one side versus the other by cutting into an election cycle? I'm going to put on my tinfoil hat. Where the hell is it? What? Go ahead, Dale.
I think we'll know the timing of it, that it will be very close once Dixie is trading 106. We'll be close to them cutting for them to ease financial conditions again, because back to 106 is going to tighten them. And, you know, no matter what they said, you know, I still need to see the 10-year back under 420 and the TLT still looks like it could have some more downside. So I think you could time a Fed cut with, I don't think they'll want the dollar up there at 106. So that's what I would look at. So that could happen very easily by June. Yesterday, my buy zone was 103.30, and so far so good. So I'm still bullish the dollar. They start
Yeah,
taking out.
last night I pointed out that in the basic technical analysis that we're gonna test that that breakout point trend line and the channel here, this one right here, and we did. I mean, I highlighted it here. So we're holding it. It's very sloppy price action in the dollar, but again, we're getting into an issue where the Fed, if they're going to cut, they need to, maybe they front load a cut. I don't know. It's going to be a very interesting next few months, and
they're damned if they do and damned if they don't. So
yeah,
Powell should do what he did about the door shutting incident and just tell them all to fuck off, and they'll do what they do when they do it.
well, that's the thing. And then here we end up getting maybe a rate cut into a political cycle. Then you're going to get an uproar from just everybody about the Fed is leaning into politics. And I mean, because I don't see any other real, unless they front load something, I just don't see any other way that they don't start cutting rates into the election cycle. That's if the market's right and if the Fed's going to do it. And but I also believe, and this is not this is the unpopular belief, obviously. I don't know if the Fed's really going to cut 3 times, let alone twice going into the remainder of 2024. I think economic data is going to continue to be really, really, really strong, and the jobs data, the labor market's not going to let up much, and inflation's probably going to be sticky, and animal spirits seem like they're still running, and we're going to have, financial conditions continuing to loosen as stocks hit all-time highs. Why should the Fed be cutting into that? I don't know. So anyway, it's going to be a really, really interesting next few months, and that's what's going to create a lot of volatility, guys and gals, even though the VIX right now is breaking down. Do you see that, Dale?
Yep.
Yeah, ugly. Ugly, supporting S&P to new all-time highs. So anyway, we got just a few minutes. We have data coming out today, don't we? Let me make sure. Let me confirm that real quick. Yeah, we have initial jobless claims. We'll get ready for those here in just 1 second. Philly Fed data. Canada housing index, current account. So all that data is upcoming here in 1 second, but let me hear from Ryan. What are your best trade ideas right at this moment, or are you just going to go have a pint early?
Well, that's very tempting. That's very tempting. I've picked up a bit of dollar mex. We've got Banxico coming up. No end of the central banks just yet. So yeah, I picked up that. I'm keeping an eye on dollar yen. It's a bit all over the place. I got knocked out of my my post BOJ long on my trading stop yesterday over the Fed. So yeah, a lot of people now speaking about whether this goes back to 152 or not. I'm in two minds. It's become a bit messy, but for now, yeah, I think see what the data comes. We've got the PMIs coming up later, so we'll get an insight in what the US is doing on that front. Services and manufacturing. Is the economy holding up, or are we going south a bit? And then we're going to see the market juggling rate expectations once more. But yeah, we're back to where we started from last Thursday. So euro dollar, can it have a move up to 110, break the 109.60 highs? And yeah, let's see what the dollar wants to do from here.
Kman, what are your thoughts going into today, buddy?
Well, I'm still short Swiss. But
you got your levels in Aussie. Did you
come again, Dale?
You were looking to sell Aussie at 66. Did you do
it? Yeah, well, have you seen that labor report? I'm far less tempted right now. Okay. It was an absolute bumper report.
It was strong.
very strong.
Yeah.
I'm gonna hold up on that one for now. And for the rest, yeah, I mean equity markets, but I'm just doing faster stuff. Can't fight the trend. No, I'm actually quite curious for today's Banxico to know whether they are going to start their cutting cycle or just do the 25 and then wait for the Fed to act.
Please, please,
That
please
one's
let
going
them
to be
start.
interesting. Hmm?
Please let them start.
Well, yeah, I mean the other Latin banks did, but then Mexico is much closer to the US than really South American banks, right?
Yeah.
So yeah, it's still a bit of a dive on its side for that one.
Jobless claims come in basically in line.
Line.
Yeah. Current account data a little smidge better. Let's see what the Philly Fed comes out. Dollar's not responding anywhere. Anything unless you guys see the Philly Fed before I do. This is the data flash inside of Forex Analytics.
3.2.
Oh, yep, it just posted. Good data. That's good. That's good.
Yeah,
A lot of people
that's
worried
been
about
bad
the
for a
manufacturing
while.
indexes really slipping. So look at this. U.S. data continues to be impressive, and the Fed, they're gonna be in a bit of a box and a bit of a pickle. What do they do? What do they do?
I like Clausen's.
You lost me
Clausen
there, buddy.
pickles. They're the
What?
best, man. Clausen pickles.
Oh, you're talking pickles. Got it. Okay.
Well, the Fed's in one, so
yes,
eat
yes,
the
that's
best.
correct.
Right.
I thought you might go into pickle jar or something like that. Anyway, Dale, do you
Pickleball.
have an interview? You have you have Jim, right? The
Yes, I
vixologist
have
coming in.
at the a vixologist.
The proctologist is on.
No, a vixologist.
All
Right,
right. Well,
Jim?
he's always really great to have him here. I'd love to hear what his breakdown of the VIX is of the breakdown of the VIX.
Yeah.
Get it?
He brought some slides.
All right, fantastic. Well, guys, gals, if you have not jumped in the ForexAnalytix community, remember it's only $1 for 10 days. You can jump in. This is the most active trading community literally in the face of the planet. You're going to find it right here.
No, the whole cosmos.
In the whole cosmopolitan area of Dale's house. Yes. So anyway, guys, jump into ForexAnalytix, download the mobile app while you do it. And Ryan Kman, great job today on the Flow Show. I got to listen to the tail end of it during this brief hiatus that we have in the weird time of the world where we changed our time zones and our times and you guys haven't. So I'm going to enjoy it for the next week and a half while I can.
So
Cheers,
thank you,
guys.
team. Really
Great
nice
stuff,
work.
Dale, Blake.
Really nice
Thank you,
work,
guys.
Ryan. Really nice
Thanks,
work.
mate. Likewise.
And thank you, Kman and Blake. And
Thank
Jim
you, gents.
Carroll. Maybe you could help me promote him. Jim Carroll.
Yeah, let me go find him. What's his last name?
Carroll.
First name Jim, right?
There we go. Yeah.
Did he come over?
It's happening.
Oh, it's happening. Okay, good. All right.
There's
Oh, he's
Jim.
here.
There's
Okay,
Jim.
very good. All right.
Okay. Thank
Cheers,
you.
Dale. Thank you.
All right. So, Jim, welcome back to F.A.C.E. How are you?
Can you hear me?
Now, yes. How are you? Nice NFT.
Can you hear me, Dale?
Yeah, I could hear you, Jim.
Awesome.
I said that's a nice NFT of yourself. I bid 500 grand for the NFT of Jim Carroll. Anyone
Done.
else? Okay, all right, man. Yeah, I'll wire it to you today. I was going to lend some money to Donald Trump to help him with his bond, but I'd rather have your NFT. So, what do you have for us today, Jim? VIX, kept holding with the market making new highs, and today looks like it's finally giving up the ghost.
Yeah.
So, a year of no fear.
Yeah, I'm gonna rip through a deck that I prepared at the end of the year.
Okay.
And there are a couple of places where I'll highlight current conditions. But you know, the gist of it is that last year was a nothing burger from a volatility standpoint. We had one little blip that we'll see, but you know, essentially nothing happened. You know, we had the regional banking collapse in 2023. Startling, but it was resolved over a single weekend. We saw VIX at its lowest close since pre-COVID. And no surprise, realized vol was very low, kept VIX in check. You know, a lot of continuing talk about zero DTE and ETFs that sell options. And, you know, meanwhile, volatility was actually hiding out in the bond market as opposed to the equity market.
Yeah.
We'll get there.
Good point.
So this is, you know, the grand scale going back to the beginning of 2020. And, you know, we've just continued to sort of drift to lower ranges over the ensuing years, color coded, but, you know, right now, really kind of no fear. If you look across the equity indices, what's interesting is you do see a you know, a spread with the S&P vol being the lowest. This is as of the end of the year, but it's pretty much in the same sequence anyway. Vol on the NASDAQ 100 higher, as you would expect, and vol on the small caps, again, even higher. You know, the small caps can't seem to get out of their own way, and the volatility there is higher than NAS 100, higher than S&P 500.
Okay.
Just a little, you know, map of last year. Again, we had that sharp but brief spike in volatility in March, and then, you know, a little mini surge associated with the October lows, but VIX barely broke 20 during that time period. And, you know, for a lot of people, 20 seems to be a bright line. I don't know that it's a bright line, but certainly, and Dean Kernett from Macro Risk Advisors is wont to say, you know, nothing bad happens with a VIX below 20. And, you know, that's probably a good way to think about it.
You
Number of
mentioned
days.
someone on your last interview that had 28 as being an important level. That means more than just a round number like 20. Do you recall?
You know, that's funny, Dale. I don't recall that. I may have said it.
Yeah, you did. Because
But
I'm an
yeah,
elephant.
I would say that you know, 25 is probably more important than 20, 28, 30. You know, when you
Yeah.
get up into those levels, you know, people think that you know, you want to hedge when VIX is low, and that, you know, certainly when VIX is low, the cost of hedging tends to be lower. But and we'll come to some visuals a bit later. You know, those hedges aren't necessarily going to do you any good. Just because you buy something when it looks cheap doesn't mean that you're getting good value. So, you know, hedging.
Yeah, you ever buy anything at the dollar store? You bring it home. It's cheap. You bring it home, it breaks.
Exactly. Maybe even before you get it home.
Yeah, you hit a bump in your car. In your car. Yeah,
So 2023 showed the fewest days with VIX above 20 since 2019.
wow.
So far in 2024, guess what the number is? 0.
Yeah.
You know, we have not had VIX close above 20 in, you know, the first
3 months.
Almost
yeah.
the first quarter.
Yeah.
So, you know, no fear. This is slightly updated from the end of the year, but it shows using the SIBO term structure what happened in March of last year when we freaked out about the regional banks. But then if you look at the average for 2023, which is the blue, it was pretty relaxed. And as of yesterday's close, thank you, Chair Powell, we're, lower left to upper right with everything below 20. So, there's no fear out there right now.
Would you say, is there any way to extrapolate no fear to euphoria? Because there may be no fear, but the market may not be euphoric either.
They do kind of go together. I feel as though we're in one of those periods where people keep looking around the corner for something to be disruptive, and that something just refuses to show up. There are a host of reasons that we might suspect more volatility. We might suspect some kind of correction in equity markets. But, whatever concern we have fails to inspire that pullback.
That's the bull market is anything that can go wrong doesn't. And the bear market's anything that can go wrong does.
Yeah.
So, it's a pretty good definition. I mean, it has shaken off everything,
certainly has.
Shipping lanes in the Red Sea.
Yeah.
Possible expansion of the war in Israel.
Mm-hmm.
Ukraine not getting arms. I mean, all the geo stuff has been, completely had no effect.
Right.
You think the presidential election will?
Well, we can touch on that.
Okay.
Let me rip through a few more of these. Again, VIX spent 2023 in a smaller range with a lower average and a lower low. One of the things I look at is, if the VIX is, how responsive is the VIX to a 1% change in S&P in the last 2 years? And there are people who will say that this is partly due to, front loading the options activity. And it could be. But there are also reasons to think that the VIX is doing just fine. But certainly, the VIX has not gone up as much per 1% down for S&P, or down as much per 1% up for SPX as it has in some prior years. And so, when the S&P moves, we're just not seeing the kind of responsiveness that we might expect. People just don't seem to be, jumping every time S&P moves in the wrong direction. This is using VIX futures, same story, lower highs, lower lows, lower average, just nobody's terribly concerned. Days in contango. This is just looking at whether the front VIX futures contract is above the second month. Essentially there was no contango in 2023. And so far this year, zero, not a single day with the front month above the second month.
Okay.
This is just looking at where VIX futures are versus VIX versus, realized volatility. We would expect that, VIX futures is at a premium to VIX spot, which is at a premium to realized. And, we ended the year with that, volatility risk premium intact and where you would expect it to be in, a normal or bullish market. And we're still there. I've talked about volley before with you. It is a measure of volatility that looks only at the money options. I like to look at it as sort of augmenting my perspective on what's going on out there. It's when the premium of VIX to volley gets out of line that something may be going on because there's a bid in in one tail or the other. And that VIX to volley spread last year, again, lower high, lower average, just not a lot of concern. Visually, that premium is on the bottom here. The top shows where VIX is relative to volley and that quote unquote fear spread. And, it just stayed below 4 basically for the entire year. And, if you see that spread rising or popping up above 5, there's something going on, because the options that are in the VIX calculation, either left tail or right tail, are being bid up relative to the at the money options. And so that's telling you that the market is beginning to price in some concern about future events. We're just not seeing it. Another one that Scott Nations and his team have developed, TDEX, the tail DEX. It's the cost of protecting against a black swan drop in the S&P 500. And, that's fell off a cliff in 2023. It just, barely got above 15 in March when we saw the regional banks concern. And, again, it got back. It's been down at pre-COVID levels basically all last year. So again, nobody wants to buy that tail protection right now. If there's no realized vol, then why should there be any implied vol? And what we saw last year was a drop in the overall levels of realized volatility. It kind of goes back to, if you look at 2017 on this chart, lowest levels ever. We're not back quite there yet, but we're staying in a fairly tight range and a very low average. 2% daily moves.
Giving up covering the VIX?
Never. Plus or minus 2% daily moves in S&P, right? In 2017 there were 0. Last year we had 2. So
yeah.
If you have no moves in the S&P, then you've got no realized vol, you've got very low levels of implied volatility. So, we keep looking for something to shake us out of this doldrum, but we refuse. One of the other things I look at is, what's the value of protection? And this is last year. If you own the S&P 500, you finished the year up, 24%. If you invested in the S&P and bought put protection, you gave back, roughly 5 points. Yeah. And if you bought VIX options as a tail hedge, you basically cut your return in half. So you were paying for protection. The protection was not paying off. And as a result, you came out worse. So,
for that reason, aren't a lot of people not doing that anymore?
Exactly.
They call it a waste of money.
Exactly. And what tends to happen historically is, when everybody has thrown in the towel on protecting their portfolios, something happens. We don't know when it is. We don't know, how it's going to arrive, where it's going to come from. But, at some point in time, those people are going to need to chase insurance. And, we've seen it before. The cost of insurance is going to skyrocket because people need to chase it. The other thing, about zero DTE is, yesterday was Fed day. So if you wanted to hedge the Fed, you had options yesterday that expired yesterday. You and I go back to the days when you'd have to go out to the next quarterly expiration if you wanted to hedge something, next week.
Right. Yeah.
Today we can target that, and that's great. But if there's a bigger event that pops up that requires protection, then all of a sudden everybody is going to be scrambling to get out, to next month or the month after that. And that's when VIX will catch a bid again.
Yeah.
So this is another perspective on tail hedges. I will not identify these two tail hedge ETFs. The one in red has announced that it's going away. But, again, putting these things in your portfolio has produced minimal positive effect. And certainly 2023 was just kind of a disaster. So this is getting to the zero DTE thing. It's a chart that people have probably seen coming out of the SIBO that, 0 day is cranking up its share of the overall volume. This is no longer a surprise to anybody. My observation is that this phenomenon has often added to intraday volatility, but also has shown some ability to dampen close to close, right, from yesterday to today. And people a lot smarter than I am seem to have drawn the conclusion that this is not Armageddon. This is not a weapon of mass destruction, but it certainly is new. The dust has not settled on how these things need to be managed or margined. And I don't know, it's something that, I'm going to continue to keep a close eye on. The other one that's gotten some headlines is this growth in ETFs that use options. A lot of options selling out there, and there's a view that the amount of option selling going on has dampened volatility. I think that's, probably true. I don't know that this is a time bomb, right? If you've got an ETF that is long the S&P and selling calls against it, I don't see the same blow up risk. People want to look at this and say this is, Volmageddon all over again. 2018, something's going to light the fuse. It's going to blow up. I don't see, with most of the structures that are contributing to this growth, where they are, creating a defined outcome. They're buying a put and selling a call. I don't see the same concern as naked selling of volatility, naked selling of VIX futures that we had in February 2018, right, that led to Volmageddon. So it's again, it's something to keep an eye on. It's important to understand the structures that are in place here. There may be circumstances where somebody is caught off sides. Frankly, I'm more concerned about the number of hedge funds that are in the dispersion trade, and that data is much tougher to come up with.
And tell our audience what the dispersion trade is.
The dispersion trade is basically looking at the volatility of the S&P 500 and the volatility of the underlying components, right? And what some people like to do is to buy the volatility of some of the underlying components and then short the index volatility to set up essentially an arbitrage or a spread trade. Okay. And that's a circumstance where you could see people running for cover if the difference in the volatilities begins to converge. If you're short the index vol and all of a sudden the index vol goes through the roof, you've got to cover that. And at the same time, you may have the vol on your underlying going the same direction, but again, you're going to have to manage that trade. It's not one where you just say, oh, hey, my call option got exercised, but I own the underlying, so there's no big deal. You know, I've capped my return.
Okay.
Last year, you know, if you want to see where the volatility was, yeah, it was in bonds. And anybody who, you know, is in the bond market will not be surprised that, you know, the MOVE index, and oh, by the way, it's come down, and I didn't have time to bring this current, but that's where the volatility was. And I wouldn't be surprised if we continue to see, you know, a decent spread between the MOVE index and the VIX index, because I think there's a decent chance, you know, with all the talk about what interest rates are going to do or not do, if we continue to see relatively more volatility in the bond market than we do in the equity markets. Just another shorter term picture of that.
Holding up so much better.
Yeah. You know, this is again that what we saw when we looked at the high-low average of the VIX was, you know, it was trending down,
Right.
and you know, this is going the opposite direction, which again, for people in the bond market is not a big surprise. But I think for the average person who thinks that bonds are less volatile, well, maybe not.
So does that opinion most people have make it vulnerable because they don't have protection?
Well, you know, I think what we saw in 2022, right, was we saw the 60-40 portfolio get, you know, kicked in the teeth.
Right.
Because the bond piece that is supposed to be less volatile and offer some protection if the stock market fades, you know, we saw both of them fade at the same time. And, you know, there aren't too many people
Bonds
still
more
in the
so.
markets.
They
Say
had
again?
like a 30 bonds, like TLT, dropped 40-50%.
Yeah, it was a rude surprise. And there aren't too many people still in the business who go back to the 70s when, you know, this kind of behavior was last seen. You know, we've been on the I wouldn't even call it a roller coaster ride. If you go back to, you know, the early 80s when the Fed when Volcker broke inflation and interest rates started to go down, you know, it's been a dramatic tailwind to the bond market and frankly to the stock market to have those interest rates in secular decline for so long. I don't know where interest rates are going to go, whether they're going to be higher for longer, whether we're going to have a second wave of inflation that's going to cause more tightening. But it certainly feels as though, you know, that secular decline may be behind us, at least for the moment. You know, the only way we see a dramatic drop in interest rates is if we get a real recession to show up and cause the Fed to freak out and go back to ZERP. And, you know, people who are hoping for lower interest rates need to be careful what they wish for, because those lower interest rates are only going to show up if things really hit the fan. Yeah, that's my view.
Okay. Great presentation once again, Jim. It's
Yeah,
amazing
so
how, it's amazing how you can make a topic that has been pretty static interesting. That's an accomplishment in itself.
That's, you know, it's you know, these are, you know, some of the questions that I've got on my mind. You know, we obviously had the Fed meeting yesterday. You know, let's talk about the volatility of inflation, right? You know, and the other thing that constantly amazes me is people say, well, inflation's under control, Jim. It's back to, you know, 3% or whatever. Like, you do realize that that is the rate of change that we're talking about. You know, do you see prices going down anywhere?
No, just not up as much.
Exactly. So it's It's amazing. And, the only people I hear saying that are people who have enough money that, they sort of don't notice,
Yeah. Yeah.
which is
Most
too
of us
bad.
do. Most of us
Anyway,
do.
that's it, Coach.
Jim, great, man. Really appreciate you coming here. We've been talking for a few years now. And so I want to thank you for educating us, uh, about the intricacies of VIX. And, it's like everything else. The minute people give up on it is when it's going to come back into vogue. The VIX is broken because of, 1-day options and all of that. But, um, you know, every dog has its day, and the VIX will have its day as well. And really, thank you, my trading warrior brother, for coming into F.A.C.E and edifying our community. Appreciate
My
it.
pleasure. Truly.
Have a great 2024 with a couple of spikes. Let's spike it up. All right, Jimmy?
Let's do it.
All right, Jim Carroll, you can follow Jim on X at the Vixologist. And do you take questions, Jim? If people DM you?
Absolutely.
Okay, so I know that a lot of people may want to learn about it. Also, the new firm that you're with, they could find you there, or you'd prefer
Yes.
Okay. And
Ballast Rock Private Wealth.
what is it? Once more.
Ballast Rock Private Wealth.
Okay. All right. Private wealth is, I think, a great term. A very wise man said, Dale, make your money in a closet. Don't flash it. Do it in the closet.
Try
So
not to
thank
be
you,
too
Jim.
flashy.
Yeah.
You're welcome.
Thanks.
Cheers.
All right, Jimmy. Take it
Bye.
easy, buddy. So everyone, that's a wrap for F.A.C.E today. We'll wrap it up with TGIF tomorrow. Good hunting. Hope we're adding value to what you're trying to accomplish in a tough game. And don't just count your pips, count your blessings. Adios.